Hello, my name's John Gullo, Chief Investment Officer of Sanderson Wealth Management, and I'll be walking you through this quarter's 15-minute financial update. Please remember, you can pause, rewind, or stop the presentation at any point in time. The second quarter was a bit of a roller coaster for risky assets. Early on, domestic, foreign developed, and emerging market stocks all rose during the month of April. The trend did not last, however, as a sell-off took hold during the month of May, causing sweeping losses. The financial markets shifted once more in June, with risky assets rising in value. In the end, the positive days outweighed the negative ones in Q2 for stocks, alternative strategies, real estate, and infrastructure, leaving only commodities with a slight loss. And when combined with the first quarter, risky assets across the board were positive for the first half of 2019, many of which with double-digit gains. So what caused the sell-off in May? It was an escalation in the trade war. The timeline can easily be reconstructed by looking at the 1,100 plus tweets the president posted during the second quarter. Now, for those of you who do not follow the president on Twitter, I'll highlight a few of them for you. The first escalation came on Monday, May 5th, when the president announced that the 10% tariff on $200 billion of Chinese goods would be raised to 25% in just 5 days. On May 10th, he stated there was absolutely no need to rush to complete a trade deal, alerting the financial markets that this process may take longer than expected. On May 30th, he shifted his focus to Mexico and threatened tariffs on all Mexican goods unless the country ramped up efforts to stem the flow of illegal immigration at the southern border. Fortunately for the financial markets, the Mexican standoff was resolved within a few short days. With trade tensions high and concerns about slowing global economic growth, the financial markets once again looked to the central banks of the world for help. It was this assumption that help is on the way that assisted the financial markets in June. Help in the form of lower interest rates. To be precise, the financial markets have now priced in a 100% chance of at least a 0.25% cut in interest rates by year end. And that's not all. They've even priced in an 87% chance of a 0.5% cut. Remember, the financial markets love lower interest rates. Lower interest rates mean cheaper borrowing costs for home buyers, car buyers, as well as businesses. Market expectations for future interest rate cuts can also be seen evolving over time by looking at the interest rate on a 10-year U.S. Treasury bond. While the interest rate rose steadily during the second half of 2016, all of 2017, and much of 2018, things changed in the fourth quarter of last year. The interest rate fell from 3.2% down to 2% where it is today. This process has resulted in funny things for U.S. interest rates as a whole. If we look back 3 years ago, the shape of the interest rate curve was normal, meaning as investors agreed to tie up their money for longer periods of time, they were rewarded with higher interest rates. Today, that is not the case. An investor who buys a 3-month or a 6-month Treasury security receives a higher interest rate than an investor who locks up their money for longer periods of time, ranging from 1 year all the way out to 10 years. Clearly, a sign that investors and market participants believe the Federal Reserve will be cutting short-term interest rates soon and forcing those yellow dots lower. Outside the U.S., interest rates are in a funny place as well. In fact, the interest rate on a 10-year government bond in the U.S. is quite high at 2% compared to other developed nations. Why? Well, it's because the European Central Bank and Japanese Central Bank continue to hold short-term interest rates near zero. In fact, investors in those countries who expect additional stimulus have pushed down the interest rate on 10-year government bonds below zero in many areas. Essentially, these investors are paying governments to take their money. For example, in Switzerland, an investor who lends the government $1,050 will receive no interest and it will be returned only $1,000 back 10 years in the future. And we're not talking about small amounts of money either. Over the past few years, there's been trillions of dollars of bonds with negative interest rates, a figure which has been increasing over the past few quarters and recently reached $13 trillion. We have discussed how investors are expecting an interest rate cut, but do we need it? In the Federal Reserve Act, Congress established the statutory objectives for monetary policy to be maximum employment, stable prices, and moderate long-term interest rates. Let's take a look at all three. When it comes to maximum employment, I think we're doing well. The unemployment rate is down to 3.7%, a level not seen since the late 1960s. In addition, average hourly earnings for non-supervisory workers are up 4% from where they were this time last year. Consumer prices have been quite stable as well. Year to date, we have been hovering between 1.5% and 2%. That is neither deflationary nor inflationary. Lastly, moderate long-term interest rates. Compared to historic levels, interest rates are well below the moderate level. They are downright low. So based on this criteria, there doesn't seem to be a need for an interest rate cut at this point in time. When we take a deeper dive into price stability, one factor which has helped keep inflation under control has been oil prices. Oil prices are well off the $100 plus levels we experienced a few years back. Why? Well, U.S. technology surrounding fracking and vertical drilling has been a game changer. Over the past few years, the U.S. has steadily increased oil production. Between 2017 and 2019, production is up 26.9% and is expected to increase an additional 7.2% in 2020. Even with OPEC countries cutting back, thanks to the U.S., global production continues to outpace global demand. Now, this does not eliminate the risk of short-term price spikes from natural disasters such as hurricanes. It does, however, keep downward pressure on prices for the long term. As we discussed a moment ago, when it comes to monetary policy, the Federal Reserve has met its statutory mandate, but it must be worried about something else. How about the unwritten objective of maximum economic growth? Next, we'll take a look at leading economic indicators to see what they show us. You can see that the last few months of manufacturers' new orders have been a bit weak. The housing market is another area of concern and has shown some softness. In contrast, consumer spending remains strong. Retail sales continue to be positive. And unemployment claims remain very low, pointing to continued strength in the labor market. Combined, these four paint a mixed picture, but nothing that warrants an interest rate cut at this time. How about sentiment readings? Is this an area of concern? Consumer confidence, which has wavered a little bit lately, remains at a very high level. A combination of low unemployment and rising wages have likely contributed to the positive outlook for consumers. In contrast, trade tensions and slowing global economic growth have led to increased levels of uncertainty from both small business owners as well as purchasing managers. If these trends continue, it would lead to a downturn in economic growth. Clearly, this is an area we will need to keep an eye on in the months to come. How about the length of the economic expansion? Is that what the Federal Reserve is worried about? We are now in month 121 of our current economic expansion, which makes it the longest in recorded history, going back to the mid-1800s. The media has spent a lot of time discussing the length of the expansion, but it spends much less time talking about its strength. Let's take a look at both. The length of the average expansion has been 58 months, or roughly 20 quarters since the end of World War II. And the strength, which is measured by the amount of economic growth achieved, has averaged roughly 23%. As we plot all these expansions, only three stand out: 1961, 1980, and 1991. Those three were exceptional in both the length of the expansion and the amount of economic growth achieved during that time period. The current expansion, while the longest in history, has clearly not yet expanded the economy enough to warrant concern of an imminent recession. Shifting gears away from the economy and towards corporate activity, sales of large U.S. companies have increased steadily over the past few years, averaging a roughly 4.2% increase. Profits have been a bit more up and down, but have averaged a 6.9% increase since 2010. The gain, however, appears to predominantly have come from the past few years. This can be attributed to one factor: tax relief. If we look at effective tax rates used to compute corporate profits, they fell from 27.9% of profits in the first quarter of 2016 to 13.2% in the fourth quarter of 2018. That is a 52.3% drop in just a few years. As such, with no additional tax cuts on the horizon, it is unlikely that corporations will be able to continue growing profits at the pace they have over the past few years. Thus far, we've discussed economic data, sentiment, the length of the expansion, as well as corporate profitability, none of which appear to be in dire straits, but one area which does warrant some concern is domestic stock valuations. Today, U.S. stock valuation ratios are well above historic levels, depicted here in yellow, as well as compared to both foreign developed stocks and emerging market stocks. Beyond the cyclically adjusted price-to-earnings metric displayed here, U.S. stocks also appear expensive when looking at other metrics, such as price-to-book value, price-to-cash flow, and price-to-earnings. In addition, the dividend yield is also much lower in the U.S. than abroad. Now, I realize I sound a bit like a broken record for those of you who have listened in to past presentations. But we strongly believe that investors who hold only U.S. stocks will be very disappointed a few years from now if they do not diversify. As we wrap up the presentation today, I wanted to take a minute to update everyone on something that is near and dear to the hearts of those who are in or close to retirement: Social Security. Currently, there are 63 million people collecting old age, survivors, and disability benefits, or OASDI for short. 6 million of which are survivors, 47 million are retirees, and 10 million are disabled. With so many recipients, this program is expensive. In fact, it cost $1 trillion in calendar year 2018 alone. And unfortunately, this is unsustainable. Since 2010, distributions have exceeded receipts from payroll taxes. It's projected to be worse in 2020, when distributions will exceed both tax receipts as well as the interest on the Social Security Trust Fund. By 2035, that reserve is projected to be completely depleted. There are, however, ways to remedy this program, and the Board of Trustees of the OASDI Trust have provided us a few suggestions. First, Congress could immediately raise the payroll tax by 2.7 percentage points, from 15.3% to 18%. And this must be done immediately. If we wait a few years, the math just doesn't work. And as a reminder, currently employees pay half of this burden and their employers pay the other half. Second, benefits could be reduced for both current and future retirees by 17%, or, as an alternative, a 20% reduction could be imposed on only those who will start collecting benefits in the future. Or third, some combination of the two. Given that Social Security recipients tend to be a strong voting coalition, and the fact that there is already a bill in Congress gaining steam which includes a tax increase, for those of us who are working, we might want to get used to the idea of a tax increase. Thank you for watching this quarter's 15-minute financial update. We hope you found it informative and interesting. If you have any questions or comments, please feel free to reach out to us. Have a great day.